Invest in someone yourself. Retirement and speculative investments. Actually, we'll do speculative investments first. And if this particular presentation seems a little choppy, it is. Because I ended up dividing the last one in half after it ended up being way too long. And so my apologies up front if it kind of cuts in and seems a little scrambled together. It's just because I ended up having to do that. So starting with speculative investments. Speculative means it's an investment involving a high risk of loss. You're speculating, you're guessing that it's going to have a good return, but it's not guaranteed. It's not like a savings account where you know you're going to be getting a set rate of return. This is highly speculative, and two of the ones that you would hear about most frequently are futures and options. And so there are two short little videos that I'll just play back to back here that do a very good job of explaining them briefly in like 2 minutes or less each. So listen to this.
A futures contract allows traders to speculate on the price movement of commodities, currencies, stock market indices, and other assets. For example, consider the fluctuations in the price of a commodity like gold. A futures trader profits by anticipating the direction gold prices will move. To help illustrate why futures exist, what they do, and how traders profit from them, let's travel back in time to one of the earliest futures markets. In 18th century Japan, rice was a key part of the Japanese economy and functioned much like a currency. The shogun paid his samurai in rice for their support, who in turn would exchange the rice for goods and services. This worked fine when prices were stable. However, if the cost of rice suddenly dropped, say as a result of several good harvests, the purchasing power of rice would decrease significantly. This would lead to problems, samurai problems. Futures contracts help solve this. With a futures contract, samurai and rice merchants could negotiate a contract with a speculator that allowed them to buy or sell rice for a fixed price at a future date. This allowed samurai and rice merchants to lock in prices and pass the risk of price change on to the speculators. The same principle is used today in a wide variety of industries. Take coffee, for example. If the price of coffee beans goes down, it's good news for coffee shops, but bad news for coffee farmers. However, if the price of coffee beans goes up, the tables turn. With coffee bean futures, both coffee producers and coffee users are able to lock in prices ahead of time. Any potential profits or losses from price fluctuations in coffee are passed on to a futures trader. Now let's look at a futures contract from a trader's perspective. Assume you had one futures contract to purchase 100 ounces of gold at $1,000 an ounce in a 4 weeks' time. Now let's fast forward. The value of gold has jumped up $10 an ounce. Your investment has increased in value because the terms of your contract allows you to purchase gold at a price below market value. How much would this contract be worth? As we mentioned earlier, the contract specified that you will purchase 100 ounces of gold at $1,000 an ounce. Each ounce is currently valued at $1,010. Your contract allows you to purchase an ounce for $1,000 and is for 100 ounces. As a result, your investment would be worth around $1,000. So how much does a futures contract cost? Buying futures is different than purchasing a stock or an option. When you purchase a futures contract, you do not need to make a large payment up front. Instead, you are required to keep money in your account to fulfill the margin requirement. The margin requirement is only a small percentage of the value of the underlying asset. It's intended to be enough to cover the likely maximum one-day loss from changes in price to the value of an asset specified by the futures contract. At the end of each trading day, this money is used to settle any gains or losses made from your investment. For example, suppose a trade moved against you one trading day. At the end of that day, money would be removed from your account to cover the losses from your futures contract. If the loss was significant and enough money was removed that your account no longer had enough cash to cover the margin requirement, then you would be in a margin call situation. What happens during a margin call depends on your broker. You may be required to deposit additional funds to cover the margin, or your trade will be automatically sold. With a futures contract, a small investment can lead to big profits or big losses. This is because a futures contract is a leveraged investment. In investing, leverage is the ability to control a large amount of money with a small investment. Futures contracts are highly leveraged. Because of this, small changes in price of the underlying asset have a much larger impact on a futures contract. This is one reason why investing in futures is much riskier than other investments. So how can you use leverage to your advantage? Leverage can be a valuable ally when an investment is used as a hedge, a way to protect your portfolio. While a leveraged investment can be useful when used as a hedge, when it's your only position, you take on an extreme amount of risk that could easily wipe out your entire portfolio. Because prices can move quickly, futures trading is only for active investors. In fact, most futures contracts are bought and sold on the same day. Unlike the stock market, futures markets are open virtually all hours of the trading week, allowing traders to buy and sell futures contracts around the clock. If you're a more casual investor who only buys or sells a few stocks every couple of weeks, futures trading may not be for you. If you're interested in learning more about futures, it's important that you expand your investing education. We strongly encourage you to learn more before you make any investments. Take control of your financial future today with Premier Education, brought to you by InvestTools from TD Ameritrade Holding Corp.
I'd like to talk a little bit about option basics. Basically, options are contracts. You pay a premium for them. Think of them like as a coupon. With a coupon, just like you normally would have if you go to a fast food place, you get an expiration date normally. They also have a price that you pay for or what you get for it. The same thing with options. It's like a premium. You get this contract that you're able to buy stock or sell stock. And that's what it allows you to do. That's the value of it, or the leverage that you're able to get out of options. So let's go over some basic fundamentals first. Basically, options control 100 shares. So if you purchase or sell one contract or one option, you're controlling 100 shares of stock. You can't do 150. It's not possible. Basically, if you get two, it's going to be 200 shares. If you get three, it's going to be 300 shares. So it goes in batches of hundreds. They expire, just like a coupon would if you get a discount coupon for a restaurant. They expire, but they expire the third Friday of the month that you purchase them for. So if you buy a longer term option, it's going to expire on that third Friday of that month. So say I buy an option contract for October, it's going to expire on the third Friday of October. In reality, it expires on Saturday, 11:59 a.m. on that third Saturday. So you want to get rid of it by that Friday or even Thursday, depending on holidays and so on. The strike price is equal to the expiration price. We'll get into all this a little bit later. And you're paying a premium for options in order to own it. Okay, so what does all this really mean? Okay, let me give you a simplified example of an option. Think of it like buying a house. If you go to a market or an area, a residential area, and you find a house that you like, and the houses there are selling for about $150,000, you go and hand somebody or knock on the door and you say, hey, I really like your house. And you know that there's development going on over there and something great is about to happen. And you're saying, hey, I'm willing to give you $10,000 right now if you're willing to hold on to this house and sell it to me within the next 6 months for our $200,000. You know, and since the average home prices are going for $150,000, you know, the guy is probably thinking, yeah, okay, I'll hold on to it, you know, within, you know, for 6 months, and you get that $10,000 no matter what. So for holding on to that and giving me the option to purchase it at some later date and time, the owner of the house wins because he gets that money. And me, I get to win because now I get to start seeing or researching the area and see, is there really development going on, even though I heard it? So it gives me the opportunity, it gives me the right, but not the obligation. I'm not forced to purchase this house, but I did pay $10,000 in order to have that option to buy it. Now, if I do decide to buy it, then all of a sudden, yeah, I would have to give them $200,000 to purchase this house. But if somebody came along and said, hey, you know, I want to buy your house for $300,000, he would not be able to do that because I right now have the legal right to purchase it for $200,000 instead of $300,000. So if somebody came along, wanted to buy it for $300,000 from him, he would have to buy out that contract from me first, and then he would be able to sell that house for $300,000. And this is what normally happens with options. Basically, what happens is that the option actually gets traded and sold versus the stock. You don't really put the stock to somebody or, get the stock by buying calls. Most people just trade the contracts. They trade just like a stock would, except at different prices and different rates, which we could go over in a little bit. But you have two types of options. You have a call and you have a put. The call, think of it, if you bought one call, it would be 100 shares of a certain stock. You're betting that the stock is going to go on the upward pattern, call up. Whereas if you buy a put, you're betting that the stock will go down. You have the right, but not the obligation to put that stock to somebody. So a stock goes down, you bought a put for $70, the stock is at 100, the stock tanks to $20. You can put that contract or those shares, you can put it to them at $70 because that's where you purchased it. So that's what most people do is they might buy protection. That's when you hear those kind of words, I'm buying protection for my stock. So a stock might be trading at 100 and you buy protection at 80 with a put. And you can do that. And you don't have to buy protection for all your shares. You can buy it for part of your shares. And it's just another way to play the game. So that's the basics and fundamentals of stock options and calls and puts. That's what they are. We'll go in detail in a little bit more on other sections, but just remember that options are like a coupon. They're a contract. They control 100 shares of stock. They do expire, so you have to know your expiration date, and over time, as they expire, they deteriorate in value. Stock, on the other hand, if you hold it for 40 years, does not deteriorate, whereas option contracts do because they do expire. The strike price is the expiration price, so you purchase it, like I mentioned, at hitting that $70 mark, that would be your expiration price. So when you're purchasing option contracts, you say, hey, I want it at 70. So if the stock doesn't hit those levels, then you don't get fulfilled or you don't get that right to be able to purchase that stock, okay? And you pay a premium for it. So you're basically paying it for a contract to have that right, to be able to say, hey, if I bought a call at 100, but the stock is trading at 50, and I buy the calls at 100, then you have to wait until that stock reaches $100 or more. If it went to $200, you can buy the stock for $100 because you have that right. You have the right to purchase it at $100. Even if the stock is $200-300, you can still buy it at $100.
All right, and again, just an overview of what options are. So now you have hopefully a little understanding of what that is, and you're starting to see there can be a wide assortment of investments and financial tools to understand. This is what majoring in finance is about if you're choosing to go to college. Speculative investments, collectibles. Well, like I said, some of you may already be speculating in investments of collectibles. There's things such as stamps that are very rare and very expensive, or baseball cards is a speculative investment. Antique automobiles or Sportster type automobiles can be a speculative investment. You're hoping that when the one you buy goes up in value and you can maybe sell it later for a profit. Art is a highly speculative investment. The auction houses, Christie's for example, deal in selling art as an investment. People may buy a $1 million painting and hope that it goes up in value later when they sell it for $5 million. Some advice for investing in collectibles. This is off of a site called The Simple Dollar. That they are saying invest only in collectibles for which you know the market well. And if you don't invest in a collectible that you know the market well, make sure you very quickly do research so that you know the market well. Stay on top of any collectibles market that you're invested in. And that is so important because the collectibles market can fluctuate so much. There are trends, something that has a lot of value one year may have hardly any value the next year. And if you are not paying attention, you can lose out very quickly whatever you have invested because you're not staying on top of what the market is doing. The best way to become a collector is to buy the items cheap. Be a bargain hunter and scout out for whatever you know about well, and so you can invest in it and buy it as cheap as you can. Keep the most valuable items secure, like in a safe deposit box or a home vault or safe. If it has that much value, it's worth protecting. Have the most valuable items professionally graded, and that can be, depending on the collectible, there are certain grades or certain levels that the higher the level, the more value it has. And oftentimes people that are professionally will grade something will also help you seal it or clean it or protect it so that it can't be altered or damaged anymore. So to take care of those collectibles. Don't have all of your money in collectibles. Diversity is king. Don't have stock and real estate and mutual funds, not just collectibles. And you do not want a collapse of the collectible market to leave you broke. Like it or not, collectibles are non-essential items and buyers can be fickle. It can be based on the economy. If the economy is down, people may not be buying. If interests were to change, your collection could devalue or lose its value relatively quickly, and that's not something you want to be exposed to. So, like I said, maybe some of you already have some collectibles, and this is some advice for you. Stay on top of it so that you understand and you can sell something before it loses all of its value. A couple of closing concepts here to review. Lending versus owning. Remember, when you are investing, you are either lending your money to the company or organization, or you own the asset. Lending, if you remember, is with bonds. You are lending your money to a company, a municipality, the government, and they are paying you interest. Owning is what you are doing when you are purchasing stock, real estate, or speculative investments. You own that asset, and you are being paid in returns either through dividends, rents, or capital gains. Knowing, again, the level of risk can help you manage your risk and understanding what kind of risk you are willing to take, the type of return, if it's paying interest, or if it's paying dividends and so on, the type of investment that you make. Bonds, mutual funds have a lower risk, and stocks, real estate can have a higher risk, but also higher return. All right, so in one of the collection slides, he talks about diversifying, not putting all of your money in just collectibles. And diversification, what that means is that you're spreading the risk out. You're spreading your dollars out and not putting it all in one thing. And your portfolio is the term, the vocab word for all of your investments grouped together. That's your portfolio, kind of like a art portfolio of work. It's your financial portfolio. So portfolio diversification reduces your risk by spreading your money among a wide array of investments. So you have an assortment. You have CDs and some collectibles and mutual funds and money market and some real estate. That's diversified. You have a little bit of money in everything. So your goal over the course of your life is to try to create a collection of investments that will provide an acceptable return with an acceptable exposure to risk. So some of you are low risk takers, some of you are high risk takers, but what's acceptable to you by spreading your money out will help meet what's acceptable to you. And by doing that, by having a diverse portfolio, you're reducing your investment risk in that you'll lose all of your money, or you'll lose a big chunk of your money. Hopefully it will, over the course of all of it being diversified, will increase. So when you invest in a mutual fund, that is automatically a form of portfolio diversification, because a mutual fund, if you remember, is taking a whole bunch of stocks or a whole bunch of bonds and spreading your money out among them. So automatically, by investing in a mutual fund, you are diversified. And here's an example of what it could look like for a typical person. So a diversified investment portfolio, that top one there, the orange and blue one, there is 60% in stock and 40% in cash and bonds and fixed investments. As an example of a diversified portfolio, not 100% in stocks, but it's split up. On the right side there, the multicolored one has 5% in what are called REITs. We won't get into that, but it's real estate, some in metals, some in stocks, some in foreign stocks, some in bonds, different kinds of bonds. And so you see how they've spread their money out. And then the bottom one shows another example. They have 10% available in cash, 20% bonds, 70% stocks. So not all of the money is 100% stocks, or not all of the money is 100% bonds. It's diversified. I don't know if you remember this lady, Michelle Singletary, and her comment that she had before: you should start saving for retirement the day you get your first job. I'm talking about your first full-time job, where you're starting to build your career, your first job when you're it. And if they offer retirement options, you should take advantage of them for sure. And if they don't, then I agree with her. You should start saving the day you get your first job. Start to set up something for your retirement. And it seems weird, doesn't it? I mean, you're like 17 years old and you're thinking, retirement? Well, obviously you don't have to start a retirement account when you're 17, but when you're 21, 22 and you get that first career job, then you should start saving. And when you are saving, when you are investing, keep in mind that each of your lives has key financial milestones. You have milestones in your life, but you also have financial milestones. So buying a home, retirement, paying for your education, paying for your children's education, having children, taking a break from a career, or losing your career for a few short months or something that is financial milestones. And the investing you do can and should change throughout your life. When you're young, you maybe are investing to save for a home, and that would be different than when you're later in your life, maybe investing for even more for your retirement. And investing for your retirement is different than just investing. Investing for your retirement is so that when you are done working later in life, you don't want to work when you're 75 or 80. Most people don't. A few people still like to work. Barbara Walters or somebody like that, you can see. But the investing you do for milestones in your life, like buying a home, is a separate account than for your retirement, because you want to have money, you hope to have money for your retirement later. And the earlier you start, if one message can come out of this whole little retirement message, is to start early. And here's an example of the difference it can make. So Mandy and Jason are both 22 years old. And this young lady, Melissa Leong, has, I think, a fun little video, and we'll watch her and what she has to say about investing early and setting money aside. So it's kind of fun. Watch her, what she has to say.
Why should you start saving for retirement sooner rather than later? Well, I've enlisted the help of two Melissas to help us answer this question. Hey ladies, looking good. Thanks. Are you hitting on me? Because that's kind of unprofessional. So what's your saving strategy? I started putting $1,000 a year into my RRSPs when I was 20. You had $1,000 to put away when you were 20? I stopped putting money into it when I was 34. So I contributed a total of $15,000 into my retirement savings. I started putting money away when I was 30. I will put $1,000 every year until I'm 64. I will have contributed $35,000. Sounds good, ladies. So let's assume that each of you make 6% annually on your investments. Melissa B would have $118,100 to retire with. Melissa A, however, would have $141,700. What? That's the magic of compounding interest.
That's awesome!
So awesome! I'm so awesome!
Oh, look at
awesome!
All right, I think she does a great job of illustrating what a difference it can make when you start investing early. So again, if I said there's one thing out of this whole thing that can make a difference, is the earlier you start, the better off you'll be in the long run over the course of your life. You can go to the Social Security government website, socialsecurity.gov, and figure out what you think your Social Security benefits will be. Because I've heard some people say, well, you know, I don't need to invest for my retirement. I get Social Security. I'll have Social Security. Well, here's the reality check on Social Security. All right, so I went to the site and I did the quick calculator to figure out, okay, so I'm your age, 1992. I think you have to be at least 21 to kind of figure out. And let's say, okay, let's assume somebody who's 21. We have some 19, 20-year-olds in this building, so that's not unrealistic. And let's say they're at a job that they're earning $40,000 a year. And let's say they kind of continue at that pace. They get a little, a raise a little bit every year. What you could expect, so let's assume this is you, in a couple of years, and you're earning the 40 grand a year at the job, and if you retire at the age of 62, which a lot of people's goal is to try to retire at 62, that'll be in the year 2054, the dollars that you would get for your Social Security benefits would be $1,088 a month, $1,088 a month. Well, now you've done some investigating about how much a car payment is, how much rental is, or a mortgage would be, and so you understand, think of buying today, think of what you would need today to have a place to live, the food that you want to do, maybe the entertainment that you want to have, the cell phone that you want to have, the lifestyle that you want to live. Realistically, would $1,000 a month do that for you? Well, a lot of people know. You're an adult, you want to have a place of your own, you want to be able to be independent and drive and so on, and $1,000 a month won't go very far to have the lifestyle that you want. So Social Security will be there. It is a base, you could look at it as a base of your retirement income, but for most people, if you want to live a somewhat comfortable lifestyle when you're retired, you want to start a retirement account of some sort. So just something to kind of keep in mind. And it also shows you, if you don't plan to retire until 67, that amount will go up to $1,500 a month. And if you continue working until you're age 70, so you don't retire until you're age 70, it would almost double. It'd be $1,900 a month that you would receive in today's dollars. So think of what you would be able to buy with $2,000 a month. And if you could do that, then you could rely just on Social Security for your retirement. But most people, that's not enough. Tax-advantaged investments. So savings and investments are a form of unearned income and therefore subject to income tax. So your investments can be taxed, but the government, through taxation that they've set, they encourage people to invest in certain types of investments. And so tax advantage investments will reduce, defer, which means to put off till later, or adjust your tax liability. And the most common investments that the government would like you to invest in, where they give you tax breaks, are in retirement investments and education investments. So if you have kids and you want to start a college fund, they'll give you tax breaks because you've done that. Or if you have a retirement account that you're setting up, they'll give you a tax break for that. They want you to be more independent when you're older. So when are taxes for tax advantage benefits usually paid? Well, you can pay them now when you're making the investment, or you can pay them later when you are taking the money out, when you're older and you're withdrawing the money. And so money is invested and taxes are paid. An example of that is called a Roth IRA. So you invest your $2,000 and you pay your taxes now, and then you're done. You can continue, that money will grow and grow and grow with a compounding interest until you're in your 60s or 70s and you start to withdraw money, and you don't have to pay any tax when you withdraw that money because you paid the tax way back here in your 20s or 30s when you invested that money. Or compare that to, let's say now you invest your money in a traditional IRA, not a Roth IRA, and that's the difference between them. Again, your money grows and grows and grows, and then when you're later in your life, in your 50s or 60s or 70s, and you start to withdraw that money, that's when you will pay the taxes, and that is a traditional IRA. So there are different ways to pay your taxes, different ways, different strategies people will use. And that's pretty complicated for right now, but it's an awareness thing again, to know that you'll be met with that choice. Do I want a Roth IRA where I pay my taxes now, or do I want a traditional IRA where I pay my taxes later? Investing for retirement. We'll just spend a little bit of time on this. You will choose an investment. For most people, it's typically a mutual fund because it's diversified. You'll contribute your money. Typically, it will be tax advantage. It will come out of your paycheck and you won't pay taxes on it. And whenever possible, use an employer-sponsored plan, because many times the school district does it. My employer, the school district, matches funds. So if I put in, $100 a paycheck or $50 a paycheck, District 279 matches that. And a lot of jobs, a lot of companies will do that. And a lot of times there's up to a certain limit, and the school district has that as well. So that is instantly you're getting a return, because that's just money that you didn't work to earn. It's automatically income. Retirement accounts, so there, as I mentioned, the employer sponsored. There are very similar plans. There's something called a 401k or a 403b for like school districts, tax exempt organizations. And then there are personal retirements account where you can set up on your own separately. So they're not through your work, they're just through a bank or they're through a broker. And that would be a traditional IRA, for example, when the taxes are taken when you withdraw the money later in life, like we just talked about, or a Roth IRA where taxes are paid when you deposit the money. So you'd pay the taxes now. So the trade-off to having those tax advantages is most accounts have penalties if you withdraw your money early. So if you keep it in there until your retirement age, there's no penalty. But if you decide in your 30s to withdraw that money, you'll pay a penalty. The government will take a part of your money that you've deposited. You'll pay a penalty for that because you've been paying less tax on it, because it's an incentive. And there are many other types of plans available. These are kind of the most common, the biggest ones, the ones that you'll most likely be offered. So an IRA, the personal one, is, as of this year, the maximum you can contribute each year to your traditional or Roth IRA is $5,500. Those are just limits that the government sets. And your return, your rate of return, will depend on the performance of the investment in the IRA account. Compare that to like a CD that we've already talked about, where you are paid a specific rate of interest over time. Maybe you're earning 6% interest. An IRA does not give a guaranteed rate of return. It will fluctuate depending on if you have it in the stock market or a bond market or whatever. And IRAs are individual. They're not through your employer. They're not a joint account with a spouse when you get married. It's your IRA. Compare that to a 401k. The limit for contributions to a 401k, the most you can contribute or pay into it in 1 year is $17,500. An employer can match additional money to your 401k. They may not match the full $17,500 if that's what you decide to invest, but they are able to match. It's an employee-sponsored a deferred income plan, and you will designate a portion of each paycheck to be put into the plan, so it will automatically come out of your paycheck. You won't even see it. It'll just go right away into that account, and the 401ks are handled through an employer.